Good morning, everybody. So this will explain to you the importance of managing shareholder relations and complying with the rules in Globus. So what I'd like to point out to you is down at the bottom of the finance and cash flow decision screen, right? Finance and cash flow decision screen. This applies to everybody, not just to poor company C who's being gutted. I'm going to pull out several of you folks. There's a mandated minimum requirement of $100 million in the ending equity. And the reason I picked Company C for this demonstration is last year they finished with $98.3 million in ending equity. Obviously, they did not comply with that mandated minimum ending equity. However, I had not yet covered that with the class, so there will be no penalty. So I want to talk to you a little bit about that and why ending equity is important. So one of the most important metrics to determine your performance is going to be return on equity, right? And that's literally divided, literally we're taking profit and dividing it by ending equity in a normal situation. So in this case, for Globus, they take beginning equity plus ending equity and they divide that by two, right? And this is a weighted average measure of financial performance. The investor's expectations get higher each and every year. So you have to get better at managing your investors' money each and every year. Okay. If we look at the financial statistics, you'll also see where ending equity is reported. So in this case, you see Company C finished with ending equity of $98,286,000. Now keep in mind, when you're talking about numbers in Globus, you need to pay attention to the numbers that you're talking about. And balance sheet data is reported in thousands. Income statement data is reported in thousands. So when it says 98,286, the correct way that you report that is that's $98,286,000. So as I mentioned the other day, equity can come from two places. It can come from the owners of the company, and it can come from earnings that have been earned and retained. In other words, they have not been paid out to the owners. That's the only place that equity can come from. And we have this mandated minimum ending equity of $100 million that Globus has kind of artificially placed on us. The reason that number is so important is if we can get that number down to $100 million and keep it at $100 million, we effectively make the denominator of our fraction return on equity 1. If we can earn, let's say, a net profit of $88 million and we have average equity of 100 million, then we have an 88% return on equity. In this case, you can see that Company C had roughly $50 million net profit and they had roughly 100 million ending equity. So if we look at their return on equity for this year, you will see they had exactly a 50% return on equity. Okay. So you've got to be careful with that equity number. I can give you the calculation, and I'd prefer to do it when I actually have a whiteboard that I can write on, but we can predict what our equity is going to be with some degree of accuracy. So we know our beginning equity, right? That's a given number. That appears in our company's financial statements. It appears as our ending equity, right? Our ending shareholder equity becomes our beginning shareholder equity for the next period. So that's a known quantity, okay? We also can predict the amount of money that we're going to put into repurchasing our company's stock. In this case, Company C plans to purchase 320,000 shares of stock, and Globus actually calculates what your stock price is going to be. If you purchase none, it'll be 70.24. They plan to purchase 320,000. Thus, the stock price is going to go up. That's simply a supply and demand in play. Okay. We're repurchasing some percentage of our stock, and our stock price is going up that amount. But we know if we repurchase 320,000 shares of stock and our stock price is 71.45, we know that that's going to cost us $22 million. $22,864,000 to be exact. So if we repurchase stock, we do so with our equity. So we take our beginning equity, we add our earnings, we subtract our stock repurchases, and we subtract our dividends. When we do that, that gives us our projected ending equity, right? We've just projected how much money we're going to spend repurchasing stock. And that, folks, is a given, right? That is a given. We've also declared a dividend. We've been very intentional. Their declared dividend is $1.90. That equals a dividend payment of 35,308,000 shares. So it's very simply the number of shares of stock that the company has times the dividend that the company declares. That amount is also coming out of equity. So it gets subtracted from our beginning equity. Again, going back to my formula, which I'd love to write on the board for you, but you can write this down. Beginning equity plus earnings minus stock repurchases minus dividends equals our ending equity, right? Now, our earnings are the only one of these that's not for sure known. We can project how much our earnings are going to be, and Globus does a pretty good job of projecting that for you. The earnings in this case for Company C, based on the decisions that they have made, are that they will earn $70,580,000 in net profit. Now, the question is, will they actually do that? Right? We don't know for sure how much your profit is going to be. That's simply a projection, okay? What we do know is based on our decisions, this is what Globus thinks we're going to make, okay? So the question becomes, if I need to keep a mandated minimum of $100 million, how can I make that happen, right? Globus has some fail-safes in place. So for example, if you go in here and you declare a dividend that would drop your ending equity below $100 million, Globus won't let you do that. It'll tell you the dividend must be a valid number and it gives you a range. Okay, so it says it can be as much as $2.48. Okay, 247 actually, because we get some rounding in there. So if I declare a dividend of $2.47 and I repurchase 320,000 shares of stock, and if I wind up with $70,580,000 in net profit, then I will have $100,001,000 in ending equity. Okay. Any more than that, and Globus will not allow us to make those decisions. You see the error message pops up. It reset the dividend. That's what happened to Company C last year. When they entered the amount of stock that they wanted to repurchase, it reset their dividend to zero. And because I had not yet covered that, it didn't catch. The team did not catch that their dividend had been reset to zero. So they want to declare a dividend of $1.90, and they want to repurchase 320,000 shares of stock. If they do that, they will have $110,700,000 of ending equity. Now you can hedge your bets a little bit, and you'll have to pay attention to me here, okay? I'm gonna try to put this all in one video. I'll record another video with a different company, but I'm gonna try to record this and let you know what happens here, okay? If you will take a look at bonus point awards from the Camera and Drone Journal, one of the awards that is offered is the Bullseye Award. In order to earn that Bullseye Award, you have to have your revenues plus or minus 5%, your earnings per share plus or minus 5% or 10 cents, and you have to have your image rating plus or minus 4 points. What you can see is last year, Company C did not earn the Bullseye Award in year 8. They missed their revenue projections by 4.3%. They missed their earnings projections by 12%, and they missed the image rating by 2 points. If you miss any one of those, you cannot earn the Bullseye Award. The company that did earn the Bullseye Award was Company E. They only missed revenue projections by 1.1%. They missed earnings per share by 3.6%, and they missed their image rating by 2 points. So they qualified for the bullseye rating or for the bullseye award. Okay. Here's how you hedge your bets on how much is enough equity for us to leave as a cushion in there. Last year, Company C missed their earnings projections by 12%. In year 7, they missed their earnings projections by 1.2%. In year 6, they missed their projections by 8.4%. Right? You can be as sophisticated as you'd like here. And what I'm going to do is I'm going to take my phone as a calculator, right? And I'm going to add 8.4% in year 6, and I'm going to add 1.2% in year 7, and I'm going to add 12% in year 8, and I'm going to divide that by 3. On average, Company C has missed their projections by 7.2% each year, right? And we have a trend of that. They've missed the projections each year under by an average of 7.2%. So how much stock should they repurchase if they want to be safe in making their decisions? I would submit to you that $10 million is probably a pretty good amount, right? $10 million, 10.7 million is actually more than that 7.2%. 10.7 million, 10.7 million cushion that they have in their ending shareholder equity. If I divide that by 70,580,000, they've got a 15% cushion. So they're probably really, really safe, and they're very unlikely to go under that mandated minimum. I would say they could probably be a little bit more aggressive in this case. I'm not recommending it because they did miss last year, but 7.2% times 70.58 million means that if they leave about half that much, 5,008,000 in there, 105.8, then they're probably okay. So they could buy back a little more stock. Let's see if we take that to 325. Okay. 350. 375. Right, we don't want to drop that below 100 million. Go to 380. 106.4. Let's try 390. Okay, now they've got 105,700,000. Okay, so they have a cushion of 5.7 million. Again, 5.7 million is what percent of 70,580,000? It is 8%. Okay, so they've left themselves sufficient cushion, in my opinion, with these decisions. Now, I'm not going to change their decisions, right? Their decision was they wanted to repurchase 320,000 shares of stock. Okay, so they do that. They leave themselves 10 million in cushion, right? You have to make that decision for your company, and this number, this ending shareholder equity, is one of the most important numbers in the simulation, because if you can get that number to 100 million, let me go back to the financial statistics for the company. If you had your ending equity each year to 100 million, look at this. Company A's return on equity, net profit divided by average equity, would be 78%. Company B's would be 88%. Company C's would be 50%. Company D's would be 68%, right? I'm not going to read them all. You can read Company F's would be bumping 100% return on equity, right? Critically important number. That's the number that drives the whole set of financial performance. It drives your stock price. It drives your earnings per share. It drives everything, okay? So critically important. That's all I'm going to show you in this video. Next video, I'll come back and look at a different company and show you what an impact managing correctly that return on equity number can have for you. Okay. All right. I'll talk to you in just a moment.